If you want to get rich in 2024, help out your family, provide for them the way that you always dreamed of, watch this video. If you don't, it was nice knowing you for about 10 seconds now, and I hope you do well. In this video, we're going to get into exactly what's going on in our markets in a way that you're not going to hear anywhere else. This is kind of like a blueprint for 2023, how to make a substantial amount of money. Unfortunately, nobody's talking about this, so I have to. Let's go ahead and get started. The triple Qs reached a new all-time high today, but this is actually not where you want to be for 2024. I'm going to give you the secret sauce, if you will, for 2024. It's not in the indexes. It's in interest rate sensitive companies, high quality interest rate sensitive companies, preferably small mid-cap stocks. There's a very specific reason for this. The fundamentals of this are quite simple. How come Google was down 1%, Microsoft down 2.27%, Amazon down 1%, and Apple really didn't do much at all today compared to a Tesla that was up almost 5%, when Tesla really didn't have any specific breaking news of any importance. See, in 2022, these names, Google, Microsoft, Amazon, the stocks that are getting sold off today, those stocks benefited from the Fed raising rates. You might ask, how is that? How could they possibly benefit from the Fed raising rates? It's called interest on $50 to $100 billion a piece sitting in bank accounts, essentially, or cash equivalents, yielding 5% for the last 6 months. Think about it like this. No company decides whether or not to get Microsoft Cloud services based on what the Fed does with Fed policy. If anything, the marketplace becoming more competitive might push more companies to get Azure Cloud software, for an example, or Google advertisers. If the economy is slowing and different areas are not doing well, maybe because of the Fed, you might see more advertising because people and companies are trying to grow their business. Those are two examples, but those examples can be made for all of these companies. They're not interest rate sensitive. You could argue they're not as economically sensitive as well if we were to go into a recession. So these guys were the clear winners in 2023 and some parts of 2022. Not for 2024. This is actually the last place that I would want to put my money in 2024. This is a chart of where Fed policy is predicting the Fed funds rate is going to be in 2024. That is this orange line right here. The Fed's currently expecting to cut rates 3 times. Guess where the markets are? At 6 rate cuts. Just before the Fed meeting, you were at 4 rate cuts. So within the last 24 hours, markets are now expecting 2 more rate cuts from the Fed. The markets are now leading the Fed heading into 2024. The market's telling the Fed they're going to cut rates even more aggressive. Well, it's going to lead to the Fed cutting rates more aggressive. That's why 10-year Treasury yields have been getting absolutely pummeled. The markets are expecting the first rate cut in March, and then we're expecting a rate cut at every single Fed meeting. That would be for March, May, for June, July, September, November, and a pause December 18th, 2024. In total, the markets are pricing in 6 rate cuts. The way I see it, the biggest risk to our markets next year is a possible recession. That is really the only thing that could derail a multi-trillion-dollar rally. What I mean by that is there is probably $30 trillion on the sidelines waiting to buy assets. There's $6 trillion in money market funds that we know of. There's a lot more than that in treasuries. How much money's sitting in cash? Probably 30 so trillion, maybe in the 20s, somewhere in that range. You can look at the M2 money supply, but that's not including some of those other factors like treasuries, like money market funds. So there's record low allocations to stocks right now. Even during the crash of 08 and 09, more people own stock. More hedge funds and institutions were allocated to stocks. This is at a time where rates are going lower, the economy is holding up, and there's almost a record amount of cash out there in the system. I think until the economic data starts to show we're heading into a recession, stocks are going to do very well, but not just any stock. Interest rate sensitive names, a name like a Tesla if you're looking at large cap stocks, or your IWM, your small mid cap names, but stick with quality. T.S. Lombard says today, quote, "Easing is a move with risk. There is a mountain of liquidity that has been held back. Households will not be content to watch short rates roll over while equity markets rally. Households will start buying assets, financial and tangible. And banks, over-reserved with the yield curve shifting back positive, will be more than happy to turn those reserves into loans." And here you can see a chart of the mountain of liquidity that households currently have. On November 5th, we seen the largest IWM call volume that we had seen since 2013. Take a look at IWM in the year of 2013. On January 2nd, till the end of the year, IWM rallied about 42% and some change. Small and mid-cap stocks, aka the IWM ETF, rallied over 42% throughout 2013, the last time we seen a similar spike in call activity. So don't be surprised if 2024 produces a similar result. What's also very interesting is this chart. Your green and your blue lines are your smaller cap names. S&P 400, S&P 600. S&P 500 is the red line. What do you notice about this chart? The small caps tend to trade at higher multiples, higher forward PEs than large caps, than S&P 500 names. Well, since really 2021, large names, right? Your S&P 500 has traded at a higher multiple than small cap stocks. That has never really happened before in recent times. So if this is correct, I mean, there's a large PE gap here that needs to be filled, which just in simple terms means small cap stocks need to see some capital. The biggest danger or risk to small and mid cap stocks in 2024 is a recession. I don't think I'm calling out the outrageous here. I think you know that. I also think most of you guys also think that we've been in a recession for the last 2 years. I know a lot of people believe the government has cooked the numbers for a long time now. But it's safe to say, based on the data we know, we have been in a rolling recession for about 2 years now. It's just been different sectors. At times it's been manufacturing, it's been construction, it's been retail related. But we haven't went into that official recession just yet. As weird as this sounds, I don't think we're going to see a recession next year. Wall Street is currently assigning the probability at about 45%, whereas some firms like T.S. Lombard expect as high as 65% chance of a recession. Same roughly with JP Morgan. Goldman Sachs is at about 15%. They're one of the lowest expected odds of a recession next year. There's a couple of reasons why I think we could actually see a reacceleration of the economy coming next year. Let's break this down in simplest terms. If you are an average citizen that drives about 12,000 miles a year, and like my home state of Michigan, gas prices were around $5 at one point over the last 12 months. Now they're about $2.90 or so. Just some rough math here. That means that the average driver is going to save anywhere from $5 to $7 in gas a day. Let's go with $7 times 365 days a year. That is $2,555. Well, times this by roughly 200 million drivers out on our roads, And you're seeing a gas savings because of the price of gas falling of about $511 billion. In the month of November, we had about $500 billion worth of retail spending. And that's a holiday month, or a month before the holiday, where a lot of people do Christmas shopping, etc. This can be like 2 months worth of call it March or May's retail spending numbers. This could be a substantial boost to spending next year, which spending from consumers is roughly 70% of GDP every single quarter. That's one reason why I think a recession probably not coming in 2024. You could also make the argument that you could see a reacceleration. Walmart CEO just came out recently and said Walmart expects deflation in a lot of different categories for 2024 and over the next coming months. A lot of goods, some of your food products, electronics, toys, a bunch of different categories. Walmart's pretty confident that we're going to see deflation. And that can open up the door for consumers to spend money elsewhere, or maybe buy more things, which could help us avoid a recession. But I think the most important reason of all I think we avoid a recession is the government. 2024 is a re-election year. There's only been one president who has ever won a re-election. If you have seen a recession within 2 years before that re-election. So that would be if we seen a recession in 2022, the odds of young Biden actually getting reelected are basically none. If we see a recession in 2024, they're like literally none. William Taft was the 27th president of the United States between 1909 and 1913, and the US economy was in a recession from 1910 through 1911, and then ultimately 1913 through 1914. He's the only one that has ever won a re-election during a recession or within 2 years of a recession happening before an election. The government also tends to spend more money during re-election years or election years in general. I think the odds of a recession next year are quite low. Probably a bigger problem in 2025. But that does mean stocks are going to be very sensitive to economic data. Remember, in 2022, good economic data was seen as bad news, partly why the markets did so poorly. In 2022, we just kept getting good economic data until we did not anymore, and that's when stocks started to crash at the end of 2022 as everyone thought a recession was going to happen in 2023. That did not materialize. Even today, we had good economic data that help send small and mid-cap stocks higher. Retail sales was the data that we got today. Retail sales month over month for the month of November came in at positive 0.3%. The estimate was negative 0.1%. This was great news for interest rate sensitive names. We currently have the lowest allocation to stocks that we have ever seen. This is worse than the 08-09 Great Financial Crisis. More hedge funds and institutions were allocated to stocks then than they are now. At the same time, you're sitting close to a record amount of cash out there in people's hands, in bank accounts, in portfolios, that is just not in stocks. So as it looks clearer that 2024, we're not going to see a recession, more capital will start to get deployed into our markets. And I think the Fed this week really kickstarted a multi-trillion-dollar wave of capital heading back into our markets. If you look at money market funds alone, before the Rona, you were at about $3 trillion in money market funds. Now you're at about $6.2 trillion. This is very liquid capital that is just looking for yield. It looks like stocks are going to provide you a better yield at this point than money market funds, even considering the 10-year treasury yield is now under 4%. It's at 3.92%. It's gotten absolutely destroyed over the last 2 days. More money is heading back into stocks. If it has not already, it's going to continue. in my personal opinion. So there's a couple different ways to trade this. If you want to be ultra conservative, I think IWM is a great place to start. IWM hit a high of about $238 per share. This is the small and mid cap ETF that hit $238 back in November of 2021. I think you could break out to new highs for IWM in 2024. If you did get back to all-time highs, that would put your potential gain at about 20% from here. It's not terrible, but I think there's better ways to trade this. If you're looking for a stock that is very interest rate sensitive, economically sensitive, that has gotten beaten down fundamentally, and the stock itself been beaten down over the past 2 years, well, look no further than Tesla. Tesla is still down. Let's go ahead and do this calculation. Still down. It's rough. About 60-some% from all-time highs, if this is truly correct. Let's actually go ahead and do that again. Nope, about 40%. The chart was lying to me. About 39% and some change, if you want to be very specific. I think you could hit new all-time highs in 2024. The odds that we don't go higher from here for Tesla over the next 12 months, very, very low. The second stock that I like that has a certain degree of safety to it is PayPal. PayPal has been destroyed fundamentally as far as the PE multiple. The actual fundamentals themselves are better than they have ever been, which is one of the most strangest things you'll find on our markets. PayPal stock has also went from over $300 during 2021 down to multi-year lows at $61 per share. PayPal is also perceived as an interest rate sensitive name and economically sensitive name. So you should benefit if things go as I expect. And PayPal could easily see a double or more in 2024. Now, these three stocks could see a double or triple or more in 2024. SoFi, Fubo, and Snapchat. They all have three things in common. They're relatively small cap names. Fubo is the smallest cap name with a market cap of around $1 billion. That's the one I like the most for big potential upside. Fubo could see some really, really big upside if things go as planned. It's a potential buyout candidate as well as the market does improve. Hopefully they don't get bought out though. But all of these names have a couple different things in common. They're interest rate sensitive. They could benefit from refinancing, right? If the consumer's doing better, then all of these guys will do better in some degree or another. They're small and mid-cap names, economically sensitive, but they've also been improving their fundamentals over the past 2 years. Snapchat, not as much as SoFi and Fubo. SoFi and Fubo have continuously been improving their fundamentals over the past 2 years. Snapchat has seen a lot of upgrades recently from Wells Fargo and other institutions that have really given the stock some upside momentum here recently. And usually when that happens, well, it's just the start. Snapchat hit a high of $70+ during 2021. It's $16 and some change now. There could still be a lot of upside for Snapchat. Fubo, same thing, was like $40 during 2021. Now it's $3.60. SoFi was in the 20s during 2021, and now it's $9.52. At the same time, all these businesses have gotten better. Like, I really can't make a bearish thesis unless we go into a recession, which I don't think is going to happen. Now, for 2024, I think the NASDAQ, if you're looking at this with the triple Qs, could actually fall. I think the triple Qs could be negative in 2024. If not a huge gain, because they're dominated by stocks that do not benefit from rates going lower, that might actually be negatively affected by rates going lower. Again, Apple, Microsoft, Google, Amazon, stocks of that nature. So if you want to get rich in 2024, at the very least make a lot of money, small and mid-cap stocks, that's really the only place to be right now. Bonds could also be attractive, but for how long? Bonds have limited upsides. Some of these other names have a long way that they could run. Let me know what you guys think about this down below in the comment section. Like the video, subscribe to the channel. It costs you nothing to do. It costs more to breathe these days. You're taxed more on air than you are to hit the like button and subscribe to the channel. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.